You've heard that real estate funds are easy monthly income, right? But is that really how it works? The truth is that many people are investing without understanding the risks and losing money thinking they're gaining. In this video, I'm going to show you the truth about real estate funds, what no one tells you, what's really worth it in 2025, and how to use FIs to build true passive income. If you're thinking of living off income, watch until the end. Many people hear about real estate funds and immediately imagine a complex investment, reserved only for those with a lot of money or who understand economics. But the reality is quite different. FIAs are like a condominium of investors who come together to invest in properties, but instead of managing an entire building alone, you become a partner in several ventures with just a small fraction of the value. It's a smart way to invest in the real estate market without having to buy physical property. The best part, you can start with little money, sometimes less than the cost of a pizza. The operation is simple. Each FII is like a company listed on the stock exchange. You buy one unit or several, and this gives you the right to receive a portion of the rents collected monthly by the properties the fund manages. For example, if the fund has rented shopping malls, logistics warehouses, or corporate slabs, the tenants pay, and that money becomes monthly fee dividends in your account. This makes FIs an incredible option for those seeking real estate funds for passive income, with recurring payments and no headaches with tenants or maintenance. Another important detail is that, unlike direct rental, real estate funds pay taxes. Differently, in most cases, dividends are exempt for individuals as long as they meet certain criteria. This further increases attractiveness, especially for those who are starting. This is where the question arises. Is it worth investing in FEIs instead of putting money into a physical property? Well, this question opens space for a fundamental point that many ignore. Fee is versus physical property. The unspoken truth. This, is the burning question, and the answer is not as simple as it seems. Many people still have that old mentality that it's best to own a property in your own name, but this is not always synonymous with good profitability or tranquility. When you buy a physical property, you have to deal with deeds, maintenance, taxes, vacancies, and problematic tenants. With FIs, you outsource all that headache to specialized managers and receive monthly FII dividends directly in your account. With much more practicality and predictability, want to see a practical comparison? Imagine you have $40,000. With that, you can barely make a down payment on a house in the USA, and you would still take on a mortgage, fees, and obligations. Now, take that $40,000. Invest in real estate funds for passive income that pay about 0.7% to 1% per month. This can generate something around $280 to $400 monthly without having to worry about anything. Furthermore, with FIAs, you can diversify between warehouses, offices, shopping malls, while with a single property, you're betting everything on just one asset. Of course, no investment is risk-free. There are indeed risks of real estate funds, such as vacancy, low distribution, or depreciation of units. But physical property also has similar risks. Market value can fall, the tenant can leave, or the property may need urgent renovation. Difference is that investing in FI is safe in terms of predictability, liquidity, and scalability, something essential when we talk about financial freedom. And this leads us to the next point, which almost no one talks about. It should be the beginning of everything. How to choose the best real estate funds for 2025. Choosing a real estate fund can seem daunting at first glance, especially when you look at that alphabet soup on the stock exchange, HGLG11, VISC11, KNRI11. But calm down. It's not as complicated as it seems. The first thing every investor needs to understand is that each FII has a different strategy. Some focus on corporate slabs, others on shopping malls, logistics warehouses, or even paper receivables, FIs. The secret is to understand the type of property and the predictability of income it offers. Those looking for real estate funds to live off income need to prioritize consistency. Moreover, looking at monthly FII dividends in isolation can be a trap. Some funds pay a lot today, but are burning cash or selling assets, which is not sustainable. A good starting point is to analyze the vacancy rate, distribution history, property diversification, and tenant quality. If I is with atypical and long-term contracts, such as logistics warehouses rented to large companies, tend to be more stable. And of course, don't invest just because it's in fashion. The foundation of success is consistency and study. A real example? The HGLG11 fund in Brazil is known for investing in logistics warehouses and usually presents good distribution and solid management. In the USA, a REIT like Realty Income O can be compared in proposal, paying monthly dividends with strong diversification and a focus on long-term contracts. Understanding how real estate funds work, including international ones, is the differential that separates speculators from those who build real wealth. And now that you know how to choose, the next step is to understand the risks that almost no one tells you about. The hidden risks of real estate funds. What they don't tell you, many people enter FIs thinking they will make easy money every month and live off dividends in peace. But the truth is that investing in FIs is safe to a certain extent, provided you know exactly where you are stepping. The biggest mistake beginners make is thinking that a fund that paid well in the past will continue to pay forever. But the real estate market changes, contracts expire, properties depreciate, and when the investor least expects it, dividends fall or disappear altogether. A common risk is vacancy. When the fund's properties are empty, it stops receiving rent, and guess what? You stop receiving dividends. Another critical point is paper funds, which invest in securities linked to inflation or interest rates. They even pay well in certain cycles, but they can also melt when the scenario changes. In addition, some funds are highly concentrated in a single property or tenant, which makes everything more fragile. Therefore, understanding how real estate funds work is vital to mitigate these silent traps. Want to protect yourself? Diversify. Never put all your capital in a single fee, no matter how tempting it seems. Study the portfolio, the manager, the management reports. The fund has well-located properties, long contracts, and solid tenants. And of course, accept that real estate funds pay taxes. Even if dividends are exempt, you will have to declare correctly and pay income tax in case of capital gains. And speaking of selling, there's one thing many ignore, but it can make all the difference in your long-term strategy. Fee is versus Treasury Bonds. Which is best for your income? This is a classic and honestly quite valid question. What yields more, real estate funds or stocks? The answer depends on what you expect from your money. If the idea is to receive monthly passive income, FIAs or REITs in the American market win hands down. Now, if the focus is accelerated wealth growth, stocks tend to offer more return in the long run, but with much more risk and volatility. In other words, it all depends on your strategy. Let's look at a practical example. A REIT, like Realty Income O in the United States, has paid dividends every month for over 600 consecutive months. That's right. It's more than 50 years of uninterrupted payments. On the other hand, stocks like Apple, AAPL, or Amazon AMZN rarely distribute dividends, but have delivered absurd appreciation in recent decades. One focuses on paying you every month, the other on growing and multiplying your money over time. Which is better? It depends on you. The key is not to choose one or the other. A truly intelligent investor builds a balanced portfolio with real estate funds for passive income and quality stocks for appreciation. This way, you receive money now and also prepare your financial freedom for the future. And the best part, you can start small and adjust as you learn how real estate funds work and how the market reacts. But there's still one detail missing that completes this equation. And that's what you'll see now. Building true passive income with FI. Idea of living solely on the income from your investments may seem like a distant dream, but it's much closer than you imagine. With planning, patience, and discipline, it's possible to use real estate funds to live off income, receiving monthly deposits that cover your expenses and still allow for a good quality of life. The big trick is to build this flow little by little, like climbing step by step. It's not magic, but an accessible strategy even for those who earn little to make it work. It's essential to choose solid real estate funds for passive income. With well-located properties, long contracts, and professional management, there are REITs and FIEs that have paid dividends for years, with a consistent history and low volatility. Want an example? Funds like Realty Income O in the USA or HGLG11 in Brazil are known for distributing monthly dividends even in times of economic turbulence. The secret is to reinvest the profits month after month till they grow enough to cover your cost of living. But don't be fooled. Living off income requires knowing the risks of real estate funds and maintaining realistic expectations. Not a straight line. There will be months with lower distribution, changes in contracts, oscillations in unit values. Therefore,